The Fed has their own plan for the Great Reset. Now, I am joined today by a returning guest to talk about this topic. Now, of course, you know about the Euro Davos, ECB, the World Economic Forum, and Klaus Schwab and their plan for the Great Reset. But my guest today says that the Federal Reserve is fighting against that. There's all types of warring factions, and the Federal Reserve has a plan to fight back against that and force their own Great Reset by breaking the Eurobond market. We talk about from what's happening in local politics, how the Treasury and Fed are fighting, the geopolitical picture with Russia, Ukraine, China getting involved, the Nord Stream pipeline and Germany happening, all of that, how this all plays out. What happens with the Brics nations, with gold, with Bitcoin, and how the Fed inevitably wins and creates an entire new financial system in the United States. I'm joined by returning guest, everyone's favorite geopolitical strategist. I'm talking about Tom Luongo from the Gold, Goats, and Guns. He's an amazing guest. I love having him on. It was a great conversation, one I'm excited to share with you. Let's just go ahead and jump right in. All right, Tom, welcome back to the show. Long anticipated. I'm ready to get into this. So thanks for coming by.
Sure. Thank you, Mark. I appreciate it.
Yeah, I threw it out on Twitter last night, and we got, tons and tons of comments. Everybody wants to hear what Tom has to say, so I do as well. So I'm excited to jump into this. So back to the the war, right? So the way that I kind of see it as being a Bitcoiner is that everybody says, yeah, but the bankers, the central bankers, the governments will never allow that to happen. They don't want to lose control over the money, which I would agree, right? It's going to be the battle for the fate of humanity. Right. That's the way I've framed it up. I did a big show titled that the battle for the fate of humanity. But the way that you so I agree, and so then you're kind of extrapolate down to, well, then why does the Fed want to give up control over money to the ECB, or why do commercial banks want to give up power over money to the Fed or the central banks, or why does any central bank want to give it up to the IMF or whatever, right?
Right.
Yeah.
Yeah, I mean, that's basically the argument, right? I mean, and this is not to say that again, I'm a Bitcoin guy. I love Bitcoin. I love the idea of all of this stuff. And I just think that, there's a particular order of operations that has happened. We live in a fallen world. We live in a world where, we're talking about people who are, who are literal Bond villains who think that they're going to make us eat bugs, live in pods, and allow assisted suicide to be a better growth industry than oil exploration. And that's just the way we're just going to have to accept that. And they don't think that there's going to be any pushback from the other factions that have also gotten fat and happy on the system that's currently in the process of failing. And everybody has their idea of how they can get out of this. And Klaus Schwab has his idea, and Jerome Powell and Jamie Dimon and others have their ideas, and they're going to fight it out. And they're going to fight it out to the death, guys. And then the British Crown has their ideas, and the Russians and the Chinese are saying, you know what, we don't have to play any of these games anymore. You guys fight it out amongst yourselves. Call us when you're done, having a cat fight in the backyard. When somebody's finally got no hair left because you pulled it all out, and you're all bloody and battered. Hey, we still have oil, we still have gas, we still have cheap Chinese crap. We're willing to sell you. Hey, let's do the thing. And we in the global South are going to go do our thing, and you guys can, continue to play your games. And I think it's very clear from the way Powell has. I can't stress enough just how clear Jerome Powell has been about what he's prepared to do with interest rates, and everybody keeps saying, "Oh, he's going to pivot." It's like watching. I've done this for years. I used to be a sports blogger, and I used to follow hockey, and I used to remember everybody was always trying to parse whatever the GM was trying to say, when 9 times out of 10, the GM was just telling you, yeah, we're going to trade this guy because he sucks. Right. Okay? We're going to do this because we suck. And this is the way things are, and everybody's doing, the 13 ways from Sunday trying to interpret the GM speak, or in this case, the Diplo speak of what's going on here. I'm like, I got news for you. He's not talking in central bankerese. He's talking in plain language. We're raising interest rates until we break something. And the question is the question that nobody wants to face, and it's the one that I've articulated, Daniel DiMartino Booth has articulated, and now other people are finally starting to realize, is that he's going to break the levered offshore dollar loan markets. what we like to know is we called as the Eurodollar markets, and we've already gotten the big shot across the bow with the UK pension system collapse that happened a couple of weeks ago, which brought Rishi Sunak to power, and Liz Truss was thrown out, and there was a coup. There was a central bank coup in the UK over this, for the purposes of betraying Brexit and bringing the UK back into the European Union fold. And the battle lines are really clearly drawn once you see this stuff, and it's clear that the United States is like they're just very powerful forces within the United States going, no, we're not doing this.
Let's break down that Euro thing for a minute. So Truss comes in, she's all fired up, she's gonna balance the budget, she's gonna drop the taxes, all these different things. And then the whole system.
She's going to frack.
Yeah, she's going to bring energy back.
The big one is that they were going to bring oil production back online off the North Slope. Right. Big deal.
Yeah, it was a big deal.
Big deal. Big statement of British independence.
Right. And within 45 days, she's forced to step down.
Yep, she's gone. Nope, that's a no-no.
Yeah. But, I mean.
Yeah, that's a no-no.
So it's easy to look at it from that lens. It's also maybe another way to look at it is that. There is no way back to austerity without massive amounts of pain. And so she was trying to do some sort of austerity, basically trying to get the balanced budget, bring taxes down, get the economy going again, bring energy back, which is going to be a very painful process. And nobody's going to be willing to go through that pain. So could it have been that she was fired up to really affect real positive change, but the pain wasn't able to be endured? Or you think it was actually more of the conspiracy?
No, this is very clearly that. Okay, so remember, Mark, that I've said this before, and I've called it German austerity. Mm-hmm. And it's the kind that the IMF always imparts on the people that they want to colonize and take over. And what they do is they raise taxes, and they raise regulations, and they cut spending. Okay. Now, the cut spending part is the one that, we Austro-libertarians go, yeah, cut spending. Government waste is terrible. But raising taxes at the same time, and then we expect that GDP is not going to continue to contract. Like, it's always about protecting the bondholders. Right. It's always about protecting the bond markets and the credit rating of the country. That's more important than the lives and welfare of the people. Do you see the messaging here? It's always the same story. What Truss was going to do was going to be, it's similar to what Donald Trump did, and in many ways actually did do, which is, he raised some spending, and he cut taxes, and he was cutting regulations dramatically across multiple vectors, as much as he was allowed to, which would free up capital and make the capital that's deployed, more efficient by getting rid of a lot of taxes, onshoring a lot of offshore capital that was sitting in bank accounts in Ireland and tax havens around other tax havens around the world, and bring that money back and allow for a reinvestment cycle. While at the same time, we're going to have to spend some money that we don't have. But so I'm not crazy about that plan. I think that Trump's plan is fatally flawed. But by the same token, he's a Keynesian in that respect. He's a debt guy, and Truss was running basically the same plan, and for the UK gilt market to react the way it did was clearly an operation from outside forces to bring her down. Clearly an operation, because nothing she proposed was that catastrophic. I'm sorry. And anybody who believes that, I'm sorry, still walks around with their mask on outside. I'm sorry. That's how dumb this is.
What happened was
the idea that there's one last thing. The idea that the British pound would drop 9% in 2 days over this is just ludicrous. Right. It's just ludicrous.
Yeah. So obviously that the pound dropped, the yields went up, the pensioners were over levered, they couldn't cover right their margin calls. But you're saying for the pound to drop that far, that fast, there was probably some outside manipulation, sort of like when George Soros got famously rich in a day, right?
Oh, you don't think Soros was not involved in this? As far as I'm concerned, is all they had to do was drop $20 to $50 million in the UK CDS market and the UK gilt CDS market and blow the thing up, which is kind of what they did.
Right.
That's how they always do this. CDSs are credit default swaps. They're fictions, dude. I'm sorry. They're not leading indicators of anything other than malfeasance by people with way too much money on their hands that they got for free from the central banks to screw with markets and then write headlines.
So you don't think
like,
the CDS
it's all
is
coordinated?
So you don't think the CDS is a more free market? That's a better indication of what's going on?
Absolutely not. Absolutely not. They are the most manipulated markets in the world. They're more manipulated than gold.
Oh, wow.
I'm sorry. The credit default swaps sound great in theory. They're not used that way. Sure, if we didn't have completely captured markets, if we didn't have completely central bank and oligarch run markets, sure, CDSs would be a fine market innovation. But please, I'm sorry, I just don't. I've seen this too many. I've seen this game too many times. I don't buy it.
So going back to Jerome Powell in the last FOMC meeting, that's exactly what he said: is that the danger is not doing the danger is doing too little. We'd rather go too far. We'd rather break things because we have the tools to put things back together again. Right? We can put Humpty Dumpty back together again. So he's willing to go too far. I mean, he says he wants to go too far and break it. Break it, whatever it being. Most times we think of breaking it being the liquidity in the financial system. You're talking
to break inflation.
Well,
people think people think he says I'm going to break inflation, and then the more savvy among us go, yeah, but you're not breaking inflation. You're not breaking supply side inflation problems with demand side tools. You just ain't doing it. Right.
Yeah, and I mean, I think he started to pick a fight that he realized maybe he can't win, which is trying to basically bring inflation down, which is being caused by energy prices. And OPEC just says, well, we'll just cut production. You want to manipulate the prices down? We'll just cut production. We'll go a lot longer than you can. Like, you're not going to win that war.
Well, that's all Janet Yellen. Look, I think the Fed's at war with the Treasury. I think Biden works for. I think the Biden administration works for Davos. Right. I think Janet Yellen is a globalist. Right. Who her entire time as chairman of the Federal Reserve, along with Ben Bernanke, worked for European colonial powers to make sure that the United States monetary policy was subordinate to them. These are the guys that. Okay, so I've talked about SOFR and the move in the past about the United States moving off of LIBOR for debt indexing to SOFR, the Secured Overnight Funding Rate, which, by the way, is fully in effect now as of 2022. All debt in the United States is issued indexed to SOFR, and none of it is indexed relative to LIBOR.
It hasn't all been switched over, but all new debt is issued to that, right?
Like 96% of it has. I mean, they took their time, and they rolled this out over almost 5 years. They started rolling this forward. They started rolling people into SOFR in 2017. Right. But here's the gig. SOFR was designed by the Federal Reserve back in 2008. The original white papers on SOFR were presented to the FOMC in 2007 before the financial crisis. Like, they knew what was coming. They knew what they wanted to do. Right. Greenspan wanted to do this. And then Obama comes into office, him, Geithner, Bernanke, and then subsequently Yellen and all the rest. They just put it on the back burner. They didn't do a thing with it for 10 years. Instead we got shit like Dodd-Frank and the CEO, all the stupid stuff that we got. We got Dodd-Frank and all that. Whatever. Everybody complaining about Glass-Steagall. I can never remember the name of the bill where the CEOs are now responsible for their income statements. One. The name's escaping me now. All that stupid stuff, as opposed to getting a real. If anybody looked at the 2008. It looked at previous financial crises, right? There was always if the Fed raises interest rates, it's going to break something overseas. And then it'll always then translate over here because we have globalized markets. Well, once Trump was put into power and once Powell was made chairman of the Federal Reserve and John Williams was made the head of the New York Fed, SOFR was all of a sudden dusted off and they started moving it through almost immediately. And then, with a 4.5 year rollout period in order to get everybody, in order to test it and make sure it worked and everything else. And then, once that was in place, then the physical decoupling of American and U.S. banks started, which is where it brings us to the repo crisis of 2019, where J.P. Morgan starved the market of U.S. Treasuries because they refused to repo European sovereign debt. Okay. take European sovereignty as collateral for repo contracts. That, the Eurodollar system then started to implode. Jeff Snyder went over all this for years, telling everybody what was going to happen. He was right. He just was wrong about the fact that SOFR broke that link, and now this time we can do the same. There ain't going to be a Eurodollar 5 like he thinks there's going to be. There was the first 4 times we had an inversion of the Eurodollar futures curve. Like, I'm sorry, he's wrong. We can see it happening. He's wrong. Because the people who are screaming today about the Fed raising interest rates are all the people who are most vulnerable to the Fed raising interest rates, and it ain't the New York banks. They're all keeping their mouths shut. Have you seen anybody at JP Morgan or Goldman Sachs or Citigroup or Wells? Wells, the biggest mortgage lender in the world, is not complaining about the Fed pushing mortgage rates above 7%.
Yeah.
Wells.
Yeah, that's interesting.
Wells' silence on this is definite.
Yeah. And Jamie Dimon's only talking about energy. Yeah, he's not talking about rates. He's not talking about any of that.
No, none of that stuff. What he's talking about is exactly what policy is going to change. Biden is going to, he came out the other day and said there's not going to be any new oil and gas or coal drilling, while he's in office. Okay, we'll take you at your word. That means we're going to have to get rid of you then, dude. Like, depending on what happens tomorrow, so what tomorrow is so important. Like, if the Republicans take 70 seats and 5 in the House and 5 to 6 seats in the Senate and 35 state legislatures and 35 governorships, do you think there's a Democrat in the world that's up for grabs, that's up for re-election in 2024, is going to listen to a word Chuck Schumer has to say? I got news for you. I'm laying 3 to 1. I'm laying like 25% odds that Schumer gets beat tomorrow. Schumer. Yeah. In New York, because Kathy Hochul is going to lose, and they lost. They had to vote harvest 3 seats in Western New York in 2020 to really maintain their majority in the House, which, by the way, everybody forgets about. But while everybody was worried about what was going to happen on January 6th and whether Trump was going to, lead an insurrection against the Biden's inauguration and the Electoral College and all this stuff, these people were back there vote harvesting like 3 seats in Rochester, Buffalo, and 1 other seat to get these people over the line when they had lost on election night by 4 points.
Yeah.
So don't kid yourself. The whole thing was stage managed and so tomorrow, they come in with 7. You think anybody is going to listen to a thing Chuck Schumer says if he squeaks by 55-45 tomorrow, or even 52-48?
Yeah.
Are you kidding me? They'll be calling for his head.
This morning, 2 hours ago, Elon Musk tweeted out, "To independent-minded voters, shared power curbs the worst excesses of both parties. Therefore, I recommend voting for a Republican Congress," giving the president a Democratic.
Yeah, no. When a former progressive like Tulsi Gabbard sounds more based than 90% of the libertarians I see on Twitter anymore, that there's a massive political realignment happening. I mean,
going back to the Fed, tightening the screws, trying to break the Eurodollar markets, trying to defend the dollar, et cetera, et cetera. You just mentioned briefly the war between the Fed and the Treasury. So now Janet Yellen saying, well, if you're not going to help us, which, by the way, all the politicians are now jumping into the Fed. Hey, you're going too fast, too far. You got the UN jumping in saying, the UN's like, hey, stop, you're going too fast, too far. Everybody's jumping in. And now the Treasury, Janet Yellen's like, well, we'll just start buying the Treasuries again then. We'll just
try and do yield curve control through the U.S. Treasury Department and run around the Fed.
Yeah.
Okay. Good luck with that, Janet. You got $400 billion and a $1.5 trillion deficit, or whatever the number is. Have fun.
Yeah.
Like next year, you're going to have a massive deficit. The only reason she can talk that way now is because she just had the biggest tax surplus and tax. Not increase year-over-year taxing collections increase in the history.
Yeah, because of inflation.
You think that's going to happen next year?
Gains and because of all that, and that's certainly not going to happen.
Right.
Best case scenario, we already have a 20% drop in the market. So best case scenario, we have a 20% drop. It holds here. That alone is going to crush tax receipts, right? I think.
Yeah.
So
they have to start cutting spending like you wouldn't believe tomorrow.
And now the Fed is losing money, right? So the Fed isn't going to be able to pay the Treasury, so they're going to lose hundreds of billions of dollars on that as well. I mean, it's
Well, they're going to lose it. I think they're going to lose $40 to $50 billion. They've always remitted somewhere between $15 and $50 billion a year. I think this last quarter they were going to be short $15 billion. Like it's not. It's not a lot. I'm sorry. In the grand scheme of things, I know that Judy Shelton makes a big deal about this, and I'm not disagreeing with her. Politically, it's going to look bad for the Fed, and politically, the Democrats are going to make hay about this. Don't kid yourself. From a political perspective, it's a lot of money. From a budgetary perspective, it's not a lot of money. They can just stop sending $3 billion a month to Ukraine.
Yeah, but they don't want to do that. Let's talk about that.
They're getting the vapors the minute I mention that.
Yeah. Let's jump up to that level now. So, I think this is, I try to think a little bit longer term, right? I mean, it's not micromanaged. Sure. If we think longer term, I mean, we can see the whole world is changing rapidly. I mean, certainly the threat is moving from this multipolar homogeny to a singular polar to a multipolar world. And it seems that we have this Russia-Ukraine thing kind of at the center of this. I know you've been talking about this a lot. We've had conversations about it. Maybe it's a war of globalism, but it's like really accelerating. To your point, right? We're sending all this money over there, which is, of course, going into all types of different people's pockets. But then we have this acceleration, which, the Nord Stream pipeline got bombed. Mm-hmm. News on the wires coming out that now everybody in the intelligence community supposedly knows who did it. NATO, we'll call it that.
Alex Craner and I said 3 days afterwards it was the Brits and the Poles.
I mean, we've all grown up watching murder mysteries and detective shows on TV. Like, it's not hard. Like, okay, who are the players? What are the motives?
Right.
Like,
who's got motive, means, and opportunity.
Yeah, right. And now and if you look back through a long geopolitical lens, it seems like the strategy has always been to keep Germany away from Russia, right?
Of course.
If Germany's manufacturing can get the cheap commodity inputs from Russia, like that's a good match, right?
Yeah, it is a good match, and it's clear that the French and the British have always opposed. Traditionally always opposed the Germans and the Russians getting together. American foreign policy is just downstream of British foreign policy because freaking Brits have infiltrated pretty much every level of our freaking government. Our special relationship with the Brits is, mostly they tell us what to do and we run around like Rambo without a jockstrap and get it done. Right. And if not, then they meme it into existence and false flag it into existence. But I'm getting done. I'm getting tired of this. And what happened with Liz Truss and everything else, and Boris Johnson, it's very clear, like who actually, quote unquote, wears the pants in this relationship. Now, that being said, I think the situation in Ukraine and Russia bothers me because the Brits have motive, means, and opportunity. Why? What's their motive? Not just because they have British intelligence. They all think they're James Bond, blah, blah, blah. That's the cartoon version. The real thing here is that the Europe and the European Union and the old European banking system, what I've already talked about, that leveraged loan offshore dollar markets, okay, which is the source of where a lot of their power comes from within their banking system and their ability to buy, to manipulate currencies, buy favors, collect compromat, and all the rest of that, what they do, move elections, all of this stuff, comes from that. Now, if the Fed is taking the punch bowl away and saying, look, we're going to shrink our balance sheet, we're going to raise interest rates, and there's nothing you can do about it because you can't get any spending through Congress to, build back better or new infrastructure or any of this other stuff. Because as Daniel DiMartino Booth pointed out multiple times, both versions of those bills that finally got passed, the Inflation Reduction Act, which is Build Back Better, it's all kind of tax credits. It's classic stimulus. It's not UBI. It's not, we're going to print a ton of money and hand it out to people. It's more hey, we're going to give you a tax incentive to, fix a road or do this or build a bridge or, get a refinery back online. No, sorry, never mind. Not built to get a refinery.
Yeah, who would do that?
Never do that. Yeah. But it's that kind of thing. So if people don't use it, then it's not going to show up in the, then the Treasury is not going to have to write the check. It's very different. It's a passive kind of stimulus. Okay. So if if the states or the agencies don't engage in this stuff, if the people don't request the money, then the money doesn't get spent. All right? Big difference between that and what Yellen and Biden wanted, which was $6.5 trillion worth of spending that the Fed would be forced to monetize, a la the CARES Act. So what's the replacement for that if they can't get that done? Well, it's obviously war spending. So that's why the Brits bombed the Nord Stream pipeline. That's why they helped the Ukrainians bomb the Kerch Strait Bridge. That's why the attack on Sevastopol last week and the whole grain corridor, weaponizing the grain corridor and humanitarian aid and everything else. Oh, it's not like the Brits have ever, been involved in a false flag incident that,
Right.
killed civilians. Like, I don't know, the Lusitania? So it's now the Grainitania. That's what we're dealing with now. You have to look at the attack on Sevastopol is very similar to the Lusitania, a mechanism by which to try and get the United States and the rest of the world angry with Putin for, targeting civilians and humanitarian aid to the world. And at the same time, of course, Putin's running around going, look, we have 500,000 tons of grain we're willing to ship out of the Sea of Azov for free. We'll give it to you people. We'll show you our intentions are on the up and up, but we're not going to allow Ukraine to import weapons from the West to then throw at Sevastopol. We're not going to do that because we're not stupid and we're not suicidal. And you can call us nasty names all you want, and we don't care. So the thing that worries me is that they're trying to meme us into an escalation that we can't come back from that will then give Congress, the new Congress, the quote-unquote war hawk Republicans, the cover to go into a war footing to spend a whole lot of money that the Fed will be forced to monetize, to reverse QT, go back to QE, go back to the zero bound, and all the rest of it. We're already seeing that in Europe. They're doing increased military spending in Germany. They're talking about increased military spending all across Europe, and it's really nothing more than a means by which to print a bunch of euros and then stuff the banks full of reserves while the Fed is raising interest rates and draining the markets. And you have to look at it that way. Look, I heard from multiple people. Let me see if I can try and put a fine point on this, Mark, is that during COVID, right, a lot of the COVID relief funds that were sent out to hospitals or that were reserved for hospitals, right, were not spent. And we heard all these stories of, the hospitals got this money, but the banks didn't want the money back. Well, no, of course the banks didn't want the money back because they wanted that money to sit on their balance sheet as reserves because they were desperate for the reserves. They didn't want the money back. What they wanted was to keep their balance sheets from imploding so that the credit markets wouldn't implode and credit spreads wouldn't blow out and interest rate swaps wouldn't blow out and all the rest of it and currencies wouldn't collapse. And that's what this was all about. And the war in Ukraine is a similar type of operation. Okay? And you have to, and once you see it that way, you can't unsee it.
Yeah, that's what I was trying to ask about. So if they can push the war and then they have wartime spending for more weapons, et cetera, then that will somehow then force the Fed to monetize that?
Well, they have to because they're going to spend all that money. The Feds, they'll put it out on the market, but there's no appetite in the market for $6.5 trillion worth of U.S. Treasuries. Who's going to buy those?
And is there some mandate that the Fed has to buy the Treasuries?
Yeah, the Fed has to buy. If the Treasury spends the money, the primary dealers have to buy the debt, have to buy what the market doesn't buy. I.e., that's the definition of a primary dealer. And then what do? They turn right around, they flip the Treasuries over to the Fed.
Got it. And the Fed has to buy them. So the Fed is forced to ease to take on that debt.
The Fed is forced to eat spending that they don't want to eat. And that's what this is going. That's what this is all about. Janet Yellen playing games and saying that she's going to do yield curve control through the U.S. Treasury and cap the price of oil, Russian oil, are. I didn't know Janet Yellen was that stupid, but she's pretty dumb.
To think that she could cap the price of Russian oil.
Yeah, both of those things. That she can do yield curve control for any length of time against the wishes of the Federal Reserve and the U.S. banking system, and do that, without the tax base to support it for very long. She's got about $400 billion in the U.S. Treasury, and that's going to get eaten up it's going to get eaten up in no time flat. And also understand that the capping of the Russian oil price, how are they going to actually do that? Well, they're going to do that by subsidizing it.
Subsidizing it by offsetting.
Well, they're going.
How are they going to do that through subsidizing?
Well, I mean, like, think of it this way. It's not even. They're going to cap the price of Russian oil. It's actually a little bit more. What they're going to do is they're going to cap the price of electricity domestically
by subsidizing.
Sorry, I misspoke. They're going to try and cap the price of Russian oil, but they're not going to be able to. So they're just going to have to buy third-party reblended fuel and pay the price, right? But what they'll do, what Germany's already talking about doing, aside from a 90% windfall profit tax on all energy profits, not above a certain level, but all energy profits. So they've been effectively nationalized. Right. What they also want to do is cap the price of electricity for the consumer. Now, how are they going to do that? Well, they're still buying electricity from the market at whatever the market rate is. They keep the electricity producers from going bankrupt. If it's costing them 20 cents a kilowatt hour, I'm just picking numbers out of my head. These are not real. But if it costs 20 cents a kilowatt hour to produce electricity, but they cap the price at 13, well, then that 7 cents has to be made up by what? The federal treasury, or the federal government's going to have to pay it. Who's going to print those euros? Clearly, the Bundesbank. Yeah. What is that doing? Again, stuffing reserves into the European banking
system. They're already doing it in the UK, right? They've already done that.
Yeah, well, they are. That was part of Liz Truss's plan. Was okay, I'm going to do that, but I'm also going to alleviate the supply shortage by allowing oil and gas exploration and investment into oil and gas exploration back into the UK at the same time.
So that's the question, Tom. Like, it seems so obvious that however you want to frame this up, the Euro Davos ECB group or even the Fed, if they're trying to fight inflation, it's a supply side issue, as you've already made the case, which I agree, a supply side issue on the oil. Mm-hmm. They're trying to cap the price of oil. They're trying to beg or pressure OPEC to pump out more, all these things. If whoever really wanted to win that war, the obvious way would be to increase our own supply of oil and push the price down to $40-50, and they could bankrupt Russia and OPEC that way. Yeah.
Yeah.
So why not that?
If we're not doing that, then you have to ask yourself why.
That's why I'm asking you. Why not?
It's clear, because they want to actually crash the entire system, and they want us to starve, and they want to create the conditions for a justified defaulting on all of the sovereign debt. That's what they want.
The Great Reset.
George Soros has made it abundantly clear, and then he put those words into Rishi Sunak's mouth the other day. We want to default on the debt. It's too much of it. We can't pay it back. We issue perpetual bonds, consols, and then roll the fiscal and political control up into the ECB and the European Commission and do away with national governments and national central banks. That's what they want to do.
Roll out a CBDC.
And the Hobson's choice being put in front of German middle class right now is that you can either starve and freeze to death, or you can be permanently surveilled in a Minority Report style dystopia. Your choice.
And roll out the CBDC. That's like the perfect introduction of that.
Well, CBDCs are how they're going to default and still have a currency. That's the pillar of the Minority Report style social credit system in dystopia. Of course.
The thing that I don't understand about the CBDCs, though, is that obviously it's just another form of fiat. I mean, already 80% of transactions are digital anyway, so whatever. It's a digital transaction. Right. It's still a digital transaction. It's still a fiat currency. It's still whatever, right? And so, like, whenever we see currencies blow up around the world, which happens quite often, like in Zimbabwe, it's happened, multiple times, they always have to repeg it back to something of value, so they'd repeg it back to the dollar. And so what the monetary theory of value or whatever through the Austrian lens says, would say you would have to peg it back to gold or something that has value. So they peg it back to the dollar. Mm-hmm. But if everything blows up and the dollar blows up, how do they reinstitute value back into a fiat currency? Or more importantly, how do they put trust back into a fiat currency without pegging it back
I'm asking that same question. That's like, I feel like these guys are the underpants gnomes.
Yeah.
Crash the system, ... issue central bank digital currency that no one wants, ... profit. Like, I don't get it. Like, I think it's a monumentally stupid plan. I do, but by getting rid of, they're going to say, by we have a clean balance sheet now. We don't have any debt. You can invest in us now. More like, why would I invest in you? You just stole $12 trillion worth of $14 trillion worth of wealth. Yeah. Really? Really? Like, okay, you really think that's what's going to happen here? But the way they think they're going to be able to pull this off is because they have bankrupted the Russians in a war, right, and gotten them to heel, and they've destroyed the United States. Then, of course, everything is so terrible that they come out smelling like the first ones to default. They're like the first banks to go through bankruptcy during a financial crisis, right? They're usually the first ones to go bankrupt, and they're usually the first ones to come back because they've already gone through the restructuring and everything else. That's what they're thinking. They're just thinking in those kind of quote unquote, I hate to say this when I'm talking about communists here, but creative destruction.
Yeah. Controlled destructionism for them, right? Trying to get the building to fall into their lap, right?
Right.
Now
it's always about selling you. I've always about selling you freedom by putting a noose around your neck and a shock collar and an electroshock up your ass. Like, it's not hard here. Like, it's the same thing. This whole thing is one big skin. This whole thing that they've turned the entire world into is just one big Skinner box.
Now we have,
and we're all just addicted to causing each other pain.
We have the rise of the Brics nations, which on one hand seems like a credible threat. We have more than half the people alive in the world today joining that. They want to break the LBMA. They produce over 60% of the gold in the world, where the UK produces none. And so it seems like it could be a credible threat there. However, the US has the consumers, and so without consumers, that's difficult. But if they can break Russia, and now they've knocked China back to the dark ages, China's stuck importing energy and food and everything, basically, for that matter. Maybe they think, well, if we can get Russia knocked down and we can get China cornered where they're forced to play ball, then we kind of break Brics, and then we kind of get that under control.
Well, they clearly want to break the Brics up. They obviously just did so, with a major piece of it in Brazil, right? They're clearly
the B part. Yeah, that was big.
Right. They clearly want, and they just realize that they just think that if they can break Brazil, Russia, and China, then the swing states like India, because BRICS has two eyes now, right. Iran and India. So, of course, we're pressuring Iran at the same time. The problem is that the BRICS also have two S's, because there's a new one now, and that's Saudi Arabia. Right. So they've got a lot of work to do here, because everybody there is not on board with this. And, the big question now is, can the Russians rejigger their trade and their military and their internal structure in such a way that they can resist kind of ad infinitum, right? And I don't know that that's the case. I'd like to believe that it is. I'd like to believe that Putin has this mostly under control. He's not acting like he doesn't. But these are titanic forces here, and everybody has to play their hand perfectly to get out of it alive. Okay.
Yeah. Yes and no, but also you've also framed up a plan that doesn't seem like it will work. So Nietzsche says that which
right.
is falling shall ye also push. Like, the global sovereign debt bubble is bursting. The dollar bubble is bursting, and every other sovereign is bursting. The plan that they seem to have doesn't seem to work. How do you go back to a fiat currency? Probably doesn't work. How do you trust somebody who just stole the global wealth? And everyone has to play.
This is why the Fed is raising interest rates aggressively, to try and get back lost credibility, and to get rid of the Fed put and get everybody back on the risk assessment. One of the interesting things about SOFR, and I haven't really had a chance to write a piece about this, but I've talked about it a little bit here and there, is that when you really start to look at SOFR as a market-driven, collateralized rate, right, contract rate. It's got futures market, and we now have a SOFR futures curve for anticipating where it's going to be in 90 days and what people are going to how people are going to need in domestic money markets and all the rest of it. And this is all good. The interesting part about this is that the end game for SOFR domestically, after it breaks LIBOR or after it breaks the Eurodollar system, is that we can have a re-regionalization of interest rates in the United States. Remember that the Federal Reserve was originally conceived of as 12 regional banks. The Kansas City Fed, the Atlanta Fed, the Dallas Fed, the San Francisco Fed, the New York Fed, blah, 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 Minneapolis, blah, 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 right? 100 years ago, 105 years ago, or 110 years ago, this was necessary because of the rate at which, information transmitted through the economy, because, we were still, we barely had cars. Like cars were were not even a thing yet, right? So, having regional interest rates made sense, and for the so that the rate of the risk assessment rate, the foundational rate in San Francisco should be different than it is in New York. Well, with a market-driven rate like SOFR, you can actually have now a re-regionalization of interest rates, because you're going to just have banks bidding locally for money markets, and we're going to get away from it. We can actually get away from a monolithic Fed funds rate. The Fed can just, and there's a thing happening here that I think is, really looking ahead here. Well, now we're talking about looking, 5, 10, 12 years ahead here. And obviously, we may not even have an election in 2024, but I want you to understand that the model, you can see the foundations are in place for a move back to a monetary system which created the United States that we know it today, right? That when we had the Federal Reserve, which was, this was a coup against the original concept of the United States in 2013. Don't get me wrong. I hate the Federal Reserve. I'm not shilling for it here. I would love for us to go onto some kind of, 100% reserve, commodity money standard, real banking, and all the rest of it. But a market-driven rate with the re-regionalization of the Fed funds rate to put risk assessment back in the hands of private banks is a hell of a lot better than the system we have now, where we have one monolithic rate, basically set by the New York Fed, and everybody else has to eat it. And that's actually caused all sorts of internal problems here in the United States, in the same way that having a monolithic ECB funds rate, deposit rate, has advantaged Germany at the expense of, say, Italy or Spain or Greece or the quote unquote pigs. Well, it's the same problem here in the United States. Having a monolithic rate in the United States advantaged California at the expense of most of the South for decades, and the Midwest for decades. So it's the same problem writ large, and this is why. And so this is the end of the Californization of the United States, when you really start to think through how this is going to work, and why the breakup of the European Union is, in fact, I think, inevitable, because we need to have different interest rates across the EU space in order to properly assess risk and labor efficiency. Well, the same thing should be in the United States as well, but with a market-driven rate like SOFR, we can actually do that.
Yeah.
Because things can trade things can trade in Minneapolis at a discount or a premium to SOFR based on the demand for money.
Yeah.
Right? Whereas it's a lot harder for that to happen with a monolithic rate, because it's not a market-driven rate that's coming from the Federal Reserve, whereas SOFR is actually determined by the market.
And the problem with
can be once the entirety of the market is working on that rate. This is something that I've been spitballing with some people about for a couple of weeks now. But this is the first time I've actually tried to put some meat on those bones. And again, I'm not saying that I'm right about this, but it's something that we really want to start considering.
Yeah. And of course,
because if that's the case, then those are the forces at play here in the United States to ensure that the reindustrialization of the United States that happens with the last dollar bull market that we're going to have, which is not going to, by the way, be a bull market against gold and Bitcoin. It's going to be a bull market against every other friggin' crappy fiat currency. This is the one we're living through right now. And then once people really start getting real, and we're starting to see that, the Fed raised 75 basis points the other day, and gold, initially traded down and now is back up in the 1680s and is threatening 1700. I think a weekly closing price on gold about 1735, and we're off to the races back to 1900. And the same thing with Bitcoin. If we got a weekly close about 22,000, watch out, baby. We're going to be back at 30 before you even know it, because it's going to pretend that you have people finally realizing that Europe has no way of surviving this without forcing the Fed to pivot and without forcing the Fed put back onto the global market. And I just don't think that enough people believe that that's the case yet. I just don't think we've gotten, enough people to the acceptance phase of the Kubler-Ross model about, 5 stages of grief model about the end of the death of the Fed put. I think a lot of people are still in denial. And a lot of people clearly are angry and are bargaining. So
you don't think the Fed has one more put in them? I mean, it seems like you do. That's why you said, or no, you think gold and Bitcoin go.
I think the Fed wants to do away with the idea of the general Fed put for the global market. Right. I'm not saying that I don't think that at some point the Fed may not pivot, or again, markets move in waves, right? Policies move in waves. We could have the Fed go to 5.5%, break Europe, see the dollar index go to 140, back off, go back to 3%. And let that run for a while. Yeah, that'd be okay. I don't know. I mean, whatever. That would be fine. Like, that would be normal monetary policy. And then once we've internalized all that, and we've worked out some of the damage from those things, then if we need to move it back up to 5 or 6, we do so. Yeah. We should never ever go back to the zero bound.
Yeah,
ever.
That's what I think it seems like is probably the most probable outcome here, financial repression. So if they can bring the rates up to 5%, get them some room, drop it back down to 3, or maybe 4, maybe 4 is the new 2 or something, right? And then, get up to 5, get some room, bring it back down to 4, keep the bond yields low, let inflation kind of run a little hot for a while, and maybe, try to bring GDP back down that way. Seems like it might be a probable option. Or outcome, I should say. Jumping gears a little bit, you mentioned Bitcoin, and so the final stage of every empire is capital controls. Right? We have to force you to stay in the party. If I'm having a party here at my office, and hey, you're too noisy, get out, and I don't like you, get out, and I kick everybody out, eventually I have no control over anybody because no one's at my party and they've started their own party over there. And so when you look at like the fall of the USSR, right, everyone's kind of left and started these parallel markets and economies, and then they had no more control. And so if people exit, which is why you hear people like Christine Lagarde talking about having to close the exits, not just with taxes, but also with currencies as well. If we get enough people getting outside of the system, then they lose the power of that system. Now, there hasn't really been a good option, but it seems like as the world is escalating very rapidly right now, especially coming forefront, which, to people all across the world, they understand, we have 3 billion people living under strict authoritarian regimes with double-digit inflation or greater. And so for them, you don't have to explain to them why they might need a different way to store money than this fiat currency they have. In the United States, it's a little bit harder. But in Canada, we found front and center, hey, we'll just take your money anytime we want. Obviously, Russia, we froze their FX reserves. And so it's starting to come more and more and more and more. And it seems like as the world continues to break apart, which is my thesis, probably move into this multipolar world, how does the world trust each other for common trade and good? And it seems like it doesn't really work. And it's almost like we would need this decentralized ledger that nobody could control in order to bring some trust back into the world again.
I agree. I agree. I know that some people that when you asked last night what you wanted to talk with me about, a lot of people said, hey, Tom, how do you justify gold in a world with Bitcoin? I'm like, well, because a lot of people don't trust Bitcoin.
Yeah.
And a lot of people still trust gold. And it's just the way it is. And I think that I don't know that gold is going to survive as a global foundational asset beyond this cycle of history, right? Beyond this cycle. This might be the last one. The last war cycle, fourth turning, whatever you want to call it, sovereign debt crisis, saw the end of silver as a monetary metal. Right? All the central banks around the world divested the largest hoards of silver ever seen by humanity over the last 75 years. Nobody has any silver left in their reserves.
But was that a technology thing though, right? Because we needed silver for lower denominations, but once we had paper currencies, we didn't need silver anymore. So then we just kept
Well,
gold.
yeah, and technology caught up to the fact that silver is one of the best, electrical conductors on the periodic table, and blah 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 blah. The industrial demand for silver rose, and there's things we can do with these metals. Remember, I'm a chemist as well, right? And for a while I worked, in metallurgy, and in coatings, and so I've just given a lot of thought to this stuff. And at some point, it's a technology thing. Money is a technology, Mark.
But the way I meant
I
meant in technology is like gold was good for bigger denominations, silver was good for smaller denominations.
Right, of course.
Once we
and now we're
when we got paper gold certificates, we didn't need the smaller denominations anymore. So what happened is basically,
we had silver certificates in the United States all the way up until I was born in 1968. You could still turn them in up until. I know people who turned them into the Federal Reserve.
But it was demonetized in 1898 or something like that, right?
Yeah, but the point being is that silver eventually was no longer even held as a reserve asset to back the paper currency, right? And at some point, maybe we'll get to the point where gold is no longer used as a reserve asset. I don't know. I'm not going to live to see this day. We're going to see Treasury gold actually remonetized in a way that is a better way of recapitalizing the central bank balance sheets than default, which is what Soros wants to do. Soros wants to keep all the wealth that he's stolen, right? And then just have everybody default on the fiat debt, when the better thing to do is to recapitalize the entire system using the Treasury gold, but having to use it at a much higher price.
Yeah.
Again, this is not an original idea. I've talked about this a little bit, but the idea being is that, you can recapitalize the United States. You've got 8,133.5 tons of gold sitting on the Fed's balance sheet. It's $42.22 an ounce, marked to sale, not marked to market. But remember, the World Gold Council, puts that number out every quarter, telling you what that is as a percentage in mark-to-market terms of U.S.'s actual reserves. Got news for you: of the total U.S. reserves of the U.S. banking system, it's 65% of the U.S. banking system. Now, is that 65% of a very small pile of reserves on a massive pile of dollars? You bet your sweet bippy it is. But you want to recapitalize trust. It's easy.
Yeah.
You issue a 50 or 100-year bond with a 5% gold redemption clause at the end of the bond.
Well, we know that central banks are buying more gold than any time since 1971. So there's certainly
more than 50. Last year was 15% of total demand, gold demand. This year it's going to be more than that. Probably somewhere around 17 or 18. And we have to wait for the Q4 numbers, because a lot of the smaller buyers of gold from the central banks like to just make one big purchase at the end of the year. Hungary, for example, last year. Japan a couple of years ago, right? And there are only a few, like Serbia and Uzbekistan and Kazakhstan and others, who just buy every month, like it's just part of their buying program. Yeah. By the way, Uzbekistan is buying like 8.7 tons of gold a month. Wow. Uzbekistan, it's a lot of gold. 8.7 tons of gold.
Well, why would they keep their money in the financial system if Russia gets their accounts frozen? What hope do they have, right?
Right, and that's a number, by the way, where we don't know what the Russians have been buying this year, because the Russians aren't telling anybody.
Yeah, and neither does China.
Yeah. Oh, the Chinese and the Russians. And see, the thing about a gold redemption clause just to make sure everybody understands the mechanics of this, and it's just I have to run in a couple of minutes, because I've got another thing that I've got somebody waiting for me. But to remember this, you can issue. This is why I say that at some point the Fed is going to want the price of gold to rise. Oh, by the way, I also think at some point the Fed is going to want the price of Bitcoin to rise, because I also see Bitcoin entering into the global reserve system as well. I think the Fed's going to wind up putting Bitcoin on its balance sheet in 10 years. Bake your noodle. You think you're going to get rid of the Fed? No, boys. I don't think that's going to happen. But I can see the Fed buying, or at least part of the U.S. banking system being backed by Bitcoin. We're already seeing it. So there's no reason not to, we're already seeing an investment at the investment level, at the at the family office level and whatnot. Why wouldn't we see it somewhere else?
Yeah.
I would see it everywhere. So, but as far as like a gold redemption clause is concerned, you don't have to issue. You can keep the Fed funds rate at 6%, but issue 50-year debt with a 2% coupon. Now, all of a sudden, your budget crisis from a 6% Fed funds rate isn't as bad as you think it is. Now you can roll over the existing debt at 2%, paying a 2% coupon, but with the net present value of the bond being linked to the gold price. Now you can let the price of gold find its new level, and the investors will hold on to these 50-year bonds that they're only getting paid 2% in dollars every year, but they're getting 10 or 12 or 15% in gold.
Yeah.
And that way you can slowly allow the price of gold to rise to its commensurate level over 10 or 15 years. And at any point, you just leave a clause in the thing that the bond is callable at the net present value in dollars based on the current market price of gold. So that if you bought a $10,000 bond, $500 of which is at the time of the sale is recoverable, is redeemable as Treasury gold, that price of that $500 worth of gold rises to, I don't know, $1,500, and you call the bond in, and the whole bond is worth now, $12,000. You pay the people off the bondholders back in those dollars. But if you were able to do that and fix the fiscal side of the equation by doing fiscal, reasonable fiscal management, along with a re-regionalization of the Fed funds rate with SOFR and all the rest of it, and risk being assessed by commercial banks and not being set at the margin really by the central bank, and all of a sudden we have a system that's a hell of a lot closer to like Austro-libertarian utopia than you think was ever possible. It's possible, but it's going to require a dramatic amount of change, a dramatic shift in thinking. Yeah. Now here's the gig. Here's the big gig. Ready? What do you think the Russians and the Chinese are going to do at some point if anybody thinks that we're going to they could always just restate their gold reserves and then do this exact thing that I just talked about, and they will call capital away from the West very quickly. So it's going to be in the Fed's best interest, if the Fed wants to survive, that the Fed goes. If it doesn't go first, that it goes.
It would be forced to.
This is why the midterms tomorrow are so damn important.
Yeah. The game theory. It's a great plan, Tom. I think the problem with that, the biggest problem I see with that plan is that it's, too much common sense. It's too practical and it would work too well. So they probably would never want to go for that. However, it's not that far-fetched because we know what was it after 1971, the U.S. was forced to issue bonds in other currencies, right? Or other
Swiss franc bonds during the Carter administration.
So they were forced to do it, and they may be forced to do it again. I know you got to run, Tom. We went long. As always, I appreciate being able to chat with you. You write an awesome newsletter, which I recommend, Gold, Goats, and Guns. You got the podcast as well. We'll make sure to link down that below. Anything you want to shout out?
No, just follow me on Twitter. We're on TFL1728 if you want to, you want some snark with your cornflakes in the morning.
Yeah, so we'll make sure to link to Twitter, your newsletter in there, which is awesome. I recommend it. And with that, we'll wrap it up. Thanks, Tom.
Thank you, Mark. You have a good day now.
All right, that's a wrap. Hopefully you enjoyed this conversation as much as I did having it. Make sure to check out Tom Luongo's Gold, Goats, and Guns. We're going to link to that down below in the notes. Follow him on Twitter. Hopefully you take this information, think about it, absorb it, and then go discuss it. Share this information. We're trying to wake as many people up. That's my only ask. I try to bring you as much value as I can, and my ask to you is if you can share this information, discuss it, discuss these ideas, teach your kids. All right, that's what I got. As always, give me a thumbs up on this video if you liked it. Hit that subscribe button so you know when I put new videos out. And that's what I got. To your success, I'm out.